Hi, welcome to my channel, Second PUC Accountancy, Learn, Understand and Excel. Today we are going to see yet another sum under retirement of a partner where the capital accounts of the partners are to be adjusted in cash. So let's see a question. So this is the question given here for the capital adjustment under retirement of a partner. So here, Mahesh, Suresh, and Sandesh were partners, sharing profits in the ratio of 3:2:1, respectively. Following is their balance sheet as at 31st March 2025. So, given here is the balance sheet as at 31st March 2025. Let's see the entries given here in the balance sheet. On the liabilities side, we have sundry creditors 23,000, bills payable 15,000, profit and loss account 12,000, and the capitals of all the three partners Mahesh 40,000, Suresh 30,000, and Sandesh 20,000. So this is the liabilities given here. And on the asset side, buildings 45,000, machinery 25,000, stock 15,000, debtors 20,000, bills receivable 10,000, and cash is 25,000. So here the total of the balance sheet is 1,40,000. Now let's see where these entries will appear in the retirement accounts. So sundry creditors 23,000 and bills payable 23,000 will be entered in the new balance sheet on the liability side. This profit and loss account, which is given on the liability side, refers to the profit of the partners made in the previous year. So this will be distributed to the partners, to all the partners in the old profit sharing ratio on the credit side of the partners' capital account. And these capitals, that is Mahesh 40,000, Suresh 30,000, and Sandesh 20,000 will be the opening balance of the partner's capital account. Now, moving on to the assets, buildings, machinery, stock, debtors, bills receivable, and cash will go to the new balance sheet along with the adjustments if given any. Now, moving on to the adjustments given here, on 1st April 2025, Suresh retires from the firm due to his illness, and this is the adjustments given here. The first adjustment, depreciate machinery by 10%, buildings is revalued at rupees 46,500, and the third adjustment, provision for doubtful debts is to be made at 10% on debtors, and the goodwill is valued in the firm at rupees 48,000 and it has to be treated as per AS 26. And the fifth adjustment says that the capital of the new firm is fixed at 80,000 rupees. So they have given us the new capital of the firm after retirement. So the continuing partners have decided to adjust their capitals in their new profit sharing ratio after retirement of Suresh. So Suresh retires, and after his retirement, the capital of the new firm will be 80,000 rupees. So therefore, we are going to adjust the partner's capital account, and the surplus or deficit, if any, in their capital accounts will be adjusted through cash. And the retiring partner's claim is settled immediately, which means that on the retirement of the partner, his account is paid immediately through cash. So we have to prepare revaluation account, all the partners' capital account, and the new balance sheet after retirement. So now let us see how to treat all the adjustments, and let's put down what are the ratios given here in the question. The old partners, Mahesh, Suresh, and Sandesh, share the profits in the ratio of 3:2:1. And the ratio can be written as 3/6, 2/6, and 1/6. In this, Suresh, the second partner, is retiring. So the retiring partner Suresh's share will be 2/6. And the gain ratio, it is not given in the question since no information is given. The gain ratio between Mahesh and Sandesh will be 3:1. that can be written as 3 by 4 and 1 by 4. So this is the ratio given here for us in the question. Now let's see how to treat the adjustments which are given. So as per the adjustments given here, the first adjustment says that depreciate machinery by 10%. So how do we treat it in the account? The depreciation on machinery 10% can be calculated as the machinery value is 25,000 and on that 10% has to be calculated. So 25,000 into 10 by 100, which will be 2,500. That is the depreciation on machinery. So what is the treatment for that? The treatment is this amount of depreciation, that is 2,500, is a loss. So, or we can say decrease in the value of machinery. So this will appear in the revaluation account on the debit side. And since there's a decrease in the value of the machinery by rupees 2,500, this 2,500 should be deducted on the asset side of the balance sheet from machinery account. So this is the treatment for the first adjustment, that is depreciation of machinery. Now moving on to the second adjustment. The second adjustment says that building is revalued at rupees 46,500. Whenever the word says revalued, this refers to the new value of the asset. So the building's new value at the end of the year is 46,500. So we have to find out what is the difference, whether the asset has increased or decreased. So we have to take the book value of the buildings. Building's book value is 45,000. We consider it as the old value of the building, and the building value that is revalued 46,500 is considered as a new value of the building. So here the building is revalued at 46,500. So now we have to find out the difference between the book value and the new value given in the adjustment. So adjustment revalued building is 46,500, but the book value given, that is in the balance sheet given value for building, is 45,000. So the difference, if you see here, the new value is greater than the old value by rupees 1,500. So this 5,500 is the increase in the value of building. So what is the treatment for this? The treatment for this will be this 1,500 is the increase in the value of building, which is a income for the firm. So 1,500 should be written in the revaluation account on the credit side. And in the balance sheet, we can directly write the new value on the asset side. The new value is 46,500. That is in the balance sheet on the asset side, which is nothing but the book value 45,000 of the building plus the increase in the value of the building 1,500, which will be 46,500. So that is the treatment for the second adjustment. Now moving on to the third adjustment, that is the provision for doubtful debts. The provision for doubtful debts is to be made at 10% on debtors. So it is the decrease in the debtors. So they have asked us to provide a provision for doubtful debts at 10% on debtors. So debtors given in the balance sheet is 20,000. So 20,000 into 10% will be 2,000. So this is the decrease that is to be made on the debtors, which will be a loss. So the treatment for that is the 2,000 rupees, that is a provision for doubtful debts, will appear in the revaluation account debit side. And on the asset side of the balance sheet, we will deduct this amount because we have to reduce the value of the debtors. So debtors to 20,000 minus PDD 2,000, 18,000 will appear on the asset side of the balance sheet for debtors. Now moving on to the next important adjustment, that is the goodwill. So here the goodwill given here is the goodwill that is valued at rupees 45,000. So total goodwill of the firm is given and it has to be treated as per AS 26. So the goodwill of the firm valued is 48,000. So here we have to only take the goodwill of the retiring partner and distribute it to the continuing partners. So Suresh is a retiring partner. So Suresh's share of goodwill will be 48,000. That is the total goodwill into Suresh's share, 2 by 6. So here the goodwill value for Suresh is 16,000. Now this 16,000, Suresh's share of goodwill, rupees 16,000, is shared by Mahesh and Sandesh in the gain ratio, that is 3:1. So it will be borne by the continuing partners. So they have to contribute for the goodwill of the retiring partner. So the share of goodwill that is borne by Mahesh will be out of 16,000 into the gain ratio is 3 for Mahesh. So 3 by 4, that will be 12,000 will be borne by Mahesh. And Suresh share of and the share of goodwill borne by Sandesh is 16,000 into 1 by 4, that will be 4,000. So this is to be recorded in the partner's capital account as per AS 26. Now moving on to the last adjustment, it says that the capitals of the partners have to be adjusted as per the new capital 80,000 and the retiring partner is settled immediately. So first let's see how to calculate the capital. So since they have already given us the new capital of the new firm after retirement of the partner, let's first divide the share of capital for both the partners as per the new ratio. The capital of the firm is fixed at rupees 80,000. That is what given in the question. Now this capital has to be distributed to both the continuing partners. So this should be divided to the continuing partners Mahesh and Sandesh in the new profit sharing ratio. So it is assumed that the new profit sharing ratio of Mahesh and Sandesh is same as the old ratio. Why? Because there is no other ratio mentioned in the question. So the old ratio itself will be the new profit sharing ratio. So that is 3:1. So it will be 3 by 4 and 1 by 4 for Mahesh and Sandesh. So the new capital 80,000 should be distributed or it has to be divided for the continuing partners in this new profit sharing ratio. So therefore the new capital of the firm will be Mahesh's capital in the new firm will be 80,000 into 3 by 4, that is 60,000 will be the new capital for Mahesh. And for Sandesh, the new capital in the new firm will be 80,000 into 1 by 4, that is 20,000. So this 80,000 rupees new capital is divided to the continuing partners in the new profit sharing ratio 3:1, and this has to be adjusted in the partner's capital account and it is adjusted in cash. So we will see the adjustment in when we prepare the partner's capital account. So now with the given adjustments, first let's prepare the revaluation account. So as we have already seen the adjustment, so the first adjustment given is the depreciation of machinery by 10%. So the depreciation is decrease in the value of asset. So it will appear on the debit side of revaluation account as 2 machinery. That is 25,000 into 10 by 100, 2,500 on the debit side of revaluation account. Now moving on to the next adjustment, it says building is revalued. So when we had compared the old value given in the balance sheet and the new value which is given in the adjustment, we could find out that there is an increase in the value of building. So it is increase in the asset. So therefore it will appear on the credit side of revaluation account as by building, that is the new value 46,500 minus the old value 45,000, which will be 1,500. that is the increase in the value of building. The next adjustment is about the provision for doubtful debts. So it is a decrease in the value of debtors. So that has to appear on the debit side of the revaluation account. So 2 PDD, that is 20,000 into 10 by 100. 2,000 is the decrease in the value of debtors or the provision for doubtful debts. So that's recorded on the debit side of revaluation account. Now, if you see, now all the adjustments are done. When you have to take the total, you have to find the balance now. Check the totals here. Debit side is 4,500. Credit side is 1,500. So write the highest total on both the sides, 4,500, to balance the revaluation account. So if you compare here on the credit side, the total is 1,500. So it is not balancing, so we need to balance it. So credit side is lesser. So it is 4,500 minus 1,500. That will be the loss. Loss has to be written here on the credit side of revaluation account as by loss transferred to Mahesh's capital account. That is 3,000 rupees is the loss. That 3,000 rupees loss has to be divided to all the partners in their old profit sharing ratio. So 3,000 is the loss which is divided to Mahesh's capital account. 3,000 into 3 by 6, that is 1,500, right in the inner column. And Suresh's capital account, 3,000 into 2 by 6, that is his share of loss will be 1,000 rupees, and Sandesh capital account 3,000 into 1 by 6, 500 is the share of loss he has to bear. So this will be written in the inner column, the division. So the total loss is 3,000, that is written in the outer amount column. So this is the balancing figure, the loss which has to be transferred to the partner's capital account. So now let us see how to prepare the partner's capital account. So in the partner's capital account, first we have to bring down the capitals from the balance sheet. The capitals are the opening balance of the partner's capital account. So write it on the credit side as by balance brought down. So 40,000 for Mahesh, 30,000 for Suresh, and 20,000 for Sandesh. That is the capitals which is given in the balance sheet. Now next, in the balance sheet, they had given us the profit and loss on the liabilities side. So that is the profit. Again, this profit has to be distributed for the old partners, that is all the partners in their old profit sharing ratio. So we will write it on the credit side as by profit and loss account. That is total profit is 12,000, which should be distributed to all the three partners in the ratio of 3:2:1. So 6,000 for Mahesh, 4,000 for Suresh, and 2,000 for Sandesh. So this is the profit that is distributed. Then we had prepared the revaluation account. So in the revaluation account, we had a revaluation loss. So loss has to be recorded on the debit side of the partner's capital account. So bring down the revaluation loss on the debit side as to revaluation account. That is the loss, so distributed on the debit side to all the three partners, which we had already distributed in the revaluation account. 1,500 for Mahesh, 1,000 for Suresh, and 500 for Sandesh. So this is the revaluation loss which has to be brought down. Now, once we had brought down the revaluation loss, the next item that has to be treated is the goodwill. Now, on the retirement of Suresh, Suresh is retiring, so the goodwill is valued, total goodwill is valued as rupees 48,000, and we had taken the share of Suresh's goodwill, that is 16,000. So that is borne by Mahesh and Sandesh. So which has to be entered on the credit side of the partner's capital account by Mahesh. That is the goodwill that is borne by Mahesh for Suresh is 12,000. And similarly, here Sandesh is also going to bear the goodwill for Suresh, that is by Sandesh capital account. The goodwill that is borne by Sandesh for Suresh is 4,000. So this is the goodwill that is to be provided for Suresh by Mahesh and Sandesh. So now the goodwill that has been borne by Mahesh and Sandesh has to be deducted from Mahesh and Sandesh. Therefore, we will write it on the debit side as to Suresh's capital account. That is the goodwill which is to be contributed by Mahesh and Sandesh for Suresh. That is 12,000. We will deduct it from Mahesh's capital account, and 4,000 we will deduct it from Sandesh's capital account. So the entry comes on the credit side as well as on the debit side. Next is, now we are going to see how the retiring partner is to be settled. As per the adjustment given here, the retiring partner is to be paid immediately. So we are going to first balance the retiring partner's capital account. We are going to balance the retiring partner's capital account. So the credit side total of the retiring partner is 50,000. That is the highest total, 50,000. So he should be paid rupees 49,000. That is 50,000 minus Suresh's debit 1,000 rupees. So 49,000 is the amount that has to be paid to Suresh as a final settlement. So which will be written here as on the debit side to cash account, which is the final settlement that has been made to the retiring partner Suresh. So the balancing figure is 49,000 that is paid immediately in cash. So we write on the debit side as to cash account. So therefore it is to be settled immediately to the retiring partner Suresh. And now here, as per the adjustment, it says that the capitals of the continuing partners have to be adjusted in cash. And in the question, in the adjustment, they had given us the new capital. The new capital of the firm is 80,000. So now we will not balance the continuing partners accounts, but first write the new capital which is already given to us in the adjustment as the balance. So here it will be written as to balance carried down. Since the new capital is already given to us in the question, 80,000, we had already distributed to Mahesh and Sandesh in the new ratio 3:1. So this is the new capital which is already given to us in the question. So before finding the balancing figure, we are going to take that new capital and write it as balance carried down. So 60,000 was calculated for Mahesh and 20,000 is the new capital for Sandesh. So as per the given new capital. Now we are going to balance the capital account. Any difference what we get in the partner's capital account should be adjusted through cash account. So that is what is being given in the adjustment. So now one by one we are going to balance the continuing partners. Now take Mahesh's capital account. The total of the credit side of Mahesh is 46,000, whereas on the debit side it is 73,500. So 73,500, that is debit side is higher. So we are going to write the debit side total 73,500 on both the sides. Here the credit side is lesser, which says that the Mahesh's capital has a deficit. So he has to bring in additional capital to adjust the new capital which is given in the adjustment. So the amount of capital that is deficit is to be brought in by Mahesh, that is rupees 27,000, which is 73,500 minus 46,000. That will be the balance for Mahesh's capital account. By cash account, this is the balance or the deficit which is to be brought in by the partners. So for Mahesh, the deficit amount what he has to bring in will be 27,500. That is the balancing figure. 73,500 minus 46,000. So remaining, that is the deficit amount which he has to bring in more into the firm is 27,500. Similarly, let's see for Sandesh. For Sandesh, the total of the debit side, again, it is 22,000, but the total of the credit side is 24,500. Again, here, the debit side is higher. So write the debit side total 24,500 on both the sides. So here also for Sandesh, it is a shortage or deficit. So the deficit amount he has to bring in into the firm. So his deficit, we need not write it once again since we had already written by cash account. Deficit amount brought in by Mahesh is 27,500. And similarly for Sandesh, the deficit amount which he has to bring in is 2,500. That is 24,500 minus 22,000. So this is the deficit amount which has been adjusted in cash by the continuing partners according to the new capital given in the question. So therefore, now let us just bring down the new capital. So here the new capital will remain as it is, which is given in the question, in the adjustment. So two balance carry down, 60,000 will be the new capital and 20,000 will be the new capital, which we are going to bring it down here on the credit side as by balance brought down. That is the new capital as it is already given to us in the question. We have divided that for the partners. So which will be taken to the new balance sheet as a new capital. So this is how the capital account has to be adjusted if there is a surplus or deficit through cash account. So now before we could prepare the balance sheet, let's see how to find the balance of the cash. As there's a lot of changes that is taking place in the cash, we have to find out what is the actual cash that will be taken to the new balance sheet. So here, let's see a note on the cash balance. So first, let's see what is the cash which is given in our old balance sheet. That is 25,000. So that is our old cash we have in our business. Now, to that, we have to add the cash adjustment that is brought in by Mahesh. So, as we had made the cash adjustment and Mahesh had to bring in the deficit amount, rupees 27,500, that is the cash that is brought in. So, our cash account is added. It will increase. So, it has to be added to the old balance of cash. And also, the cash which is adjusted, that is brought in by Sandesh. Even for Sandesh, there was a deficit, so he had to bring in rupees 2,500. So our cash balance will increase. So it has to be added to the cash. And now the retiring partners is being paid. His account is settled. So we are paying cash. So the cash what is paid to the retiring partner should be deducted. Less cash settled to Suresh, that is the retiring partner, 49,000. So the remaining cash we have in our hand is rupees 6,000. So this is the actual cash that has to be recorded in the balance sheet on the asset side. So this information can also be prepared in an account form. So let's start with the cash account. So now let's see how to prepare this information in an account form. We are now going to prepare the cash account. to show the changes that have taken place in the cash account. So open the cash account, debit and credit side. So you have on both the sides particulars and amount column. So first we have to bring down the balance, that is C, that is the cash which is in the old balance sheet rupees 25,000 will be the opening balance of the cash account. So this will appear on the debit side to balance brought down rupees 25,000. Seen here in the adjustment, continuing partners Mahesh has to bring in cash towards his deficit. So that is cash coming in. So we are going to write it on the debit side as to Mahesh capital account, capital adjustment, that is the deficit that is brought in by him. It is 27,500. In the same manner, the other partner, Sandesh, is also bringing in the capital adjustment 2,500, which will appear on the debit side to Sandesh capital account. The deficit amount brought by him is 2,500. So now here there is some cash that is being paid as a final settlement to the retiring partner. So retiring partner is paid rupees 49,000. So here the cash is going out. So we will write it on the credit side as by Suresh's capital account. That is the final settlement rupees 49,000. So now the entries are made in the cash account. Let's see what is the balance of cash we have. Find the total. The total of the debit side is 55,000 and therefore write the same total on both the sides. The balance amount will be 55,000 minus 49,000. So we will get the balance as 6,000. We will write it as by balance carried down. So this will be the new cash balance which will be transferred to the new balance sheet. So we are going to write it even here as to balance brought down rupees 6,000, which will be taken to the new balance sheet as a new cash account. Now let's see balance sheet, preparation of balance sheet as at 1st April 2025. So here, as per the entries given in the old balance sheet, we can bring down the same order but with the adjustment. So here we can bring down the entries as it is given in the same order in the old balance sheet. But if there is any adjustment, that has to be adjusted here in the new balance sheet. So the first entry given is the buildings. So we are going to bring down the buildings here. The buildings value is being revalued. That is 46,000. That is 45,000 plus the increase in the value of the asset 1,500. So the new value of buildings is 46,500. Next we have in the balance sheet is machinery account. So machinery, again there is a adjustment. So we are going to show the adjustment here. Machinery is rupees 25,000 and as per the adjustment there is a depreciation. So we are going to deduct the depreciation 2,500. So the balance amount will be 22,500. That is the decreased value of machinery. Now as per the order given in the old balance sheet, we have stock. So as per the stock, there is no adjustment. We're going to just bring down the stock as it is, as there is no change in the value of stock. Stock is 15,000. So you can write it as it is. Next we have is the debtors. So for debtors, there is a PDD. So we have to reduce the debtors in the balance sheet. So debtors will be 20,000 less the PDD rupees 2,000. So the reduced value of debtors will be 18,000 in the balance sheet. Now after debtors, we have bills receivable. Again here there is no change in bills receivable. So we are going to put it as it is on the asset side. Bills receivable is 10,000 on the asset side. 10,000 on the asset side. Now next, the last item given in the old balance sheet is the cash. Now this cash, there is a change that is taking place as the retiring partner is being settled immediately. So cash is being given to the retiring partner. In the similar manner, the continuing partners have adjusted their capitals in cash. So the deficit amount is being brought in to the firm. So there is a lot of changes that are taking place to the cash, as we have already seen in the adjustment, which I have shown in the working note. So the actual value of cash now after all the changes is, that is 25,000 is the value of cash which is given in the old balance sheet. To that, the deficit amount is being brought in by the continuing partners, 27,500 by Mahesh and 2,500 by Sandesh should be added. Deduct the amount that is being immediately settled to the retiring partner, 49,000. So the change that has taken place in cash is rupees 6,000. So now the remaining cash we have at the end of the year is 6,000 after making all the adjustments. So this is the entries. These are the entries that are to be made on the asset side of the balance sheet. Now moving on to the liabilities side. Liabilities we had first is the sundry creditors. There's no change in the sundry creditors. So we are going to record it as it is. Sundry creditors 23,000. And next bills payable, again there is no changes taking place. So bills payable 15,000 can be recorded as it is. Now here the new capital comprises of only two partners. Since Suresh has retired, only two partners are continuing, that is Mahesh and Sandesh. So here we will not bring in Suresh's loan account because his account is completely been settled by paying him through cash. So his account will not appear on the liability side, only the continuing partner's new capital as it is already given to us in the adjustment. So Mahesh's capital is 60,000 and Sandesh's capital is 20,000. The new capital given is 80,000 in the adjustment. So that has been distributed, divided for the continuing partners Mahesh and Sandesh. So here the entries are being done in the balance sheet. So the total of the balance sheet will be 1,18,000 on both the sides, 1,18,000. So this is the total of the balance sheet. So this is how the capital adjustment is to be made in the partner's capital account and in the balance sheet. Hope this is clear, students. So with this, we are completing the retirement of a partner. Thank you.